Vision lost? What prompts a visionary to retreat from a once bold stance? In the earliest outlines of a foundational work on wealth building, a vast exploration of ownership stretched across dozens of pages, delving into the rights of those who hold stakes in a company, the evaluation of its stewards, and the subtle traps of self-interest that can undermine the common good. By its final form, this grand vision shrank to a concise handful of pages, focused narrowly on profit flows to shareholders. Why abandon such a sweeping blueprint? After years of championing vigilance over those at the helm, the conviction seemed to wane that ordinary investors would rise to the task. Yet, the need for such oversight grows clearer with time. Recent waves of corporate missteps, marked by greed, opaque records, and cunning financial maneuvers, underscore the urgency of those early warnings. Dusting off these faded lessons reveals their relevance amid today's turbulence, urging a return to the principles once held high. The custodian's role. The original vision cast shareholders not as passive spectators, but as custodians of capital, wielding authority over the enterprise. In an ideal realm, united as a majority, they could appoint or oust leaders and steer the company's path to suit their collective will. Reality, however, paints a different scene. A dispersed group, often disengaged, readily endorsing the directives of those in charge, regardless of past failures. Stirring them to act with purpose, it was once noted, would require a jolt akin to a bell ringing beneath their seats. The insight remains sharp. Owning a share means co-owning the venture. Executives serve at the pleasure of these stakeholders. The board acts as their counsel, and the company's resources, their treasury, fall under their domain. Should the operation falter, the power exists to demand new leadership, reshape governance, or liquidate assets. The call was clear. Awaken to this responsibility. Tending to this role demands as much discernment as selecting the stake itself. Two questions guide the way. Are the leaders proving their worth? Are the broader owners receiving their due? Competence shines through in results, profits, scale, and competitive edge, measured against peers. If the crew falls short, rallying key allies to press for change or insisting on candid answers from annual disclosures becomes essential. When mediocrity persists, enlisting an impartial expert to probe the enterprise can uncover truths obscured by polished excuses. Modern echoes. Today's landscape echoes these concerns with vivid clarity. Consider a titan of industry once lauded for soaring revenues and dazzling profits. A closer look at its ownership records might reveal a troubling thread. A top executive quietly steering side ventures that siphon assets from the company itself, often with its own funds paving the way. The board's approval raises questions. Does this leader prioritize the company's gain or their own? Deals that favor personal profit over corporate health signal a breach of duty, a red flag waving in plain sight. Reason must pierce through. The glitter of numbers and scrutiny of such reports, before and after committing resources, proves vital. The tussle over who truly controls the company's wealth persists. Leaders often assert their mastery over its use, claiming superior wisdom. Efficiency in operations, producing goods swiftly and smartly, doesn't always translate to fruitful stewardship of owners' capital. Excess reserves may ease executive burdens while leaving shareholders wanting. During the tech surge of decades past, the refrain grew loud. Trust the leadership to transform cash into stock price magic, with dividends cast aside as relics. Many embraced this allure, only to watch fortunes burn on reckless gambits or pile up unused, yielding little beyond idle stacks. Share repurchasing offers another twist. Done wisely, it boosts value. Fewer shares lifting each slice's worth. Yet it often morphs into a sleight of hand, issuing shares cheaply to insiders, then repurchasing them at inflated prices with company funds, masking dilution while draining the treasury. The pattern reveals a tilt toward executive gain over collective benefit. Similarly, lavish rewards, jets, options, bonuses, touted as aligning interests, frequently reward modest outcomes with outsized riches, unmoored from lasting success. The remedy lies in vigilance, dissecting records, capping windfalls at a modest share, and tying gains to sustained outperformance against peers. Imagine overseers compelled to affirm in writing that the enterprise serves its owners, not its insiders, justifying payouts and perks alike. Such accountability might rekindle the dormant spirit of custodianship, ensuring the realm answers to those it belongs to.